Welcome back to Indianomics. We are discussing the legal and foreign exchange related issues thrown up by the Tata Docomo case. I am joined now by Sandeep Parekh of FinSec Advisors and Vaibhav Parekh of Nishit Desai Associates. Well, let me start with you, Sandeep. Can the Tatas, under the circumstances, pay Docomo at all unless the law is amended?
I don't think so. And so before we start, I'd like to take us up 30,000 feet and why this policy is in place for so many years. And I think it's broadly to do with exchange control. As you mentioned, India has been hesitant to completely free debt investments into India. And one of the main reasons is the concept of carry trade, in which people come from zero interest economies and get a guaranteed return if they invest in developing economies, which has a huge, the flows would be massive and they can inundate rates, they can change rates, they can inundate the market with cheap money, cause worries on inflation. So there are a lot of macroeconomic reasons.
Basically disturb the macros.
Exactly. So there is a kind of a good policy reason for doing that, particularly last few years when we've had zero interest rates in almost the entire Western economy, almost all the Western economies. And
so capital control on debt instruments is a good idea.
I think it's a good idea, at least for the time being, till the time we achieve the scale in which we believe that the markets can self-correct and the flows will not disturb the economy per se.
But this is a fine distinction between allowing assured returns and allowing someone downside protection. Should that distinction be made?
No, I don't think that's really a distinction at all. It's a distinction without a difference, really. Because ultimately, what matters is what is the market price. If the market price is 1 rupee and you're giving 20 rupees to somebody, that's 20 times the market price of that. It has no relationship with 50% of the price paid, etc. So essentially, it is a debt-like component. It's a put-like option, and it's essentially guaranteeing something. Even if it's a return of capital or part of capital, it's still a guarantee, and therefore it has debt-like features.
Vaibhav, has the time come to make that distinction? India is not in that state of the emerging market that it was probably in the 90s and early 2000s, and the world has gone on with other equity, hybrid instruments. So has the time come, or do we have that much confidence in our FX reserves to allow foreign investors to just ensure downside protection of their capital?
Yeah, thank you, Latha. First, I just want to take a shot at a little bit of your first question because I have a slight different view from Sandeep. My view is if court considers this judgment or arbitration order as damages, because that's the way they have actually the way the order is worded, what I understand from public sources, is it is worded as a damages and not as a transfer of shares or payment for transfer of shares. And damages actually come under current account. So there is some possibility where High Court may actually say it's a payment of damages and it's a current account, and RBI really has a no say in this particular payment. So there is a possibility of court taking that view. Having said it, this is not a simple damages situation because there is also relinquishment of equity in favor of Tatas. So to some extent, I also agree with Sandeep that RBI's position is that what you can't do directly, you cannot do indirectly too. So it really depends on how court views it, whether it looks at as a situation of damages or whether it looks at a transfer of shares above fair market value, which is against the RBI regulation. Now, coming to your point, what you ask, whether India has reached, and my answer is unequivocally yes. Things have changed here. Now, if India has to compete with global economies, right, if they want to attract investment and a world-class capital investment, then you need to have laws which are similar to laws which exist in other countries. And if you really look at it in other countries, this restriction does not exist. In fact, if you look at developed world, there are no restrictions, there are no capital controls. Now, I agree with Sandeep saying that India has not reached that stage where there cannot be a capital control. There should be a capital control. There will be a capital control until India reaches to a stage where it becomes more like a developed nation. But till then, regular liberalization where it actually provides downside protection, in my view, is a good policy to attract a foreign investment.
Okay, well, Sandeep, you get one more word on that. Do you think that distinction can be made prospectively?
I don't think so. Again, we go back to the mother question of capital account convertibility. Till that happens, I don't think we can really revisit this question. And I think the real issue here is do you want to amend it anyway? Because you'll have all kinds of dubious prices coming in. If you have a market price of 1,000 rupees being traded at 40 rupees and then again next day being again traded at 5,000 rupees, do you want that kind of market? Particularly in the listed space where there is a market price, you have ballpark figures, so you can have probably relaxation for 5-7% to account for control premium, etc. But having completely, funny prices being traded in listed space, I think it'll be manipulative in the first place, and it will be unfair both on the inbound side and on the outbound side.
Well, what about this other issue itself? I mean, the court telling Reserve Bank that are you doing it at your own behest or is it at the Finance Ministry's behest? Is that does it have any bearing? Because in capital account cases, even if the Reserve Bank makes the rules, it is in consultation with the government.
Yes, I don't think it's a relevant query at all. Whether government has asked RBI to do or RBI has done it on its own, etc. The relevant question to ask is what is the law?
Well, the court has also told RBI that it is opposing an arbitral award, and does it have the power to do so? Is that also a moot question, Vaibhav?
That is a moot question. I believe RBI can oppose, and the court has actually allowed them to oppose, to intervene. And the question really is, see, basically under Indian law, court can set aside arbitration award if it is against public policy. One of the public policy is that it is patently against the law. And if Reserve Bank of India has said this award is against the law, then it is fair for the court to hear why it is against the law, and if court gets convinced against the law, they can set aside the arbitral awards.
Well, just to finally wind up this issue of the Reserve Bank's role itself, while the Finance Act has passed the rule that capital account transactions on equity instruments will henceforth be governed by the government, it's not yet amended. So what is the current position? RBI continues to make the rules?
Yes, I mean, that's how the laws are never effective till they're notified. So obviously it's the position which was always there. In addition, one last point I'd like to make here is also there's a 1969 circular under SCRA, which is also very relevant, because that completely prohibits any puts, calls, other options in not just listed securities, but also public limited companies. So that's actually one step further. It actually prohibits, makes it illegal. You can go to jail for actually entering into these kind of contracts.
But then a lot of companies would be guilty in that case.
Yes. I mean, it's enforced in the breach, that's true. But the fact is, something which is illegal automatically becomes void. And if it's void, then it's certainly not enforceable.
So would you say that SCRA rule needs to be amended to simply allow these instruments?
I've been advocating that. So SEBI has relaxed it a little bit for private equity transactions in certain circumstances. Since 1969 to I think 4 years back they amended it. So it was an absurd position for a long time. But again, we should argue for policy changes, but not say that the law is invalid when it's in fact in the books.
Okay, fair point. Your point, Vaibhav, it looks like there will be Docomo cannot get that money.
I again go back to the point where it depends really on how court looks at it, whether court looks at it as a damages case or they look at a transfer of shares over and above fair market value, and which is against Indian law, and that's the way I look at it. Now again, if you look at from perspective, I don't believe the way contract was worded from what you told and what I've read, that it was actually a put option. I believe the obligation on Tata was to find a buyer at either a fair market value or at 50%, whichever is higher. What I think arbitration order says is that Tata failed to find a buyer, right, at the agreed price, and as a result, there is a loss which was suffered by Docomo, and the damages is equal to whatever the amount they have given. Obviously, someone can question whether the amounts have been properly arrived to or not.
I don't think the court is questioning that part of the contract. I thought the court is questioning the fact that in the event you don't find a buyer, then you will have to buy back the share at an assured price. It is that assured price that's being disputed, isn't it?
Exactly.
I was just saying that the contract, what I understood from market sources, the contract did not have obligation for Tata to purchase the shares of Docomo. I don't think that was also mentioned in the arbitration award. Okay. What I understood is arbitration award said you failed to purchase, you failed to find a buyer to purchase Tata Docomo shares, and because you failed to meet your obligation, there is a loss which Docomo has suffered, and you need to pay damages, and damages end up being equal to
Okay.
1.17 billion dollars.
Fair point. Sandeep, Vaibhav, thank you very much for joining me in this discussion. Well, what will we watch for from the court in the coming days? First, much will depend on whether the court buys Reserve Bank's argument that public policy will be hurt by allowing Docomo to be an exception to its current policy. Second, whether the court believes Tatas are paying damages and not an assured return. And finally, whether Reserve Bank's initial okay to the Docomo payment is important enough to make a distinction between assured return and downside protection. Well, that's what we're going to watch in future pronouncements of the court. Thank you for joining me on this edition of Indianomics.